Okay, we are going to get started. Good morning, everybody. My name is Ian Campbell. I'm the Vice President of Operations for PACICC, and I am the staff lead for the Risk Officers Forum, and I'm your moderator for this morning's broadcast. It's the first time we're having a morning webinar, so this should be interesting. I want to thank my colleague, Danica Hall, who is working behind the scenes to keep things moving. Thank you very much, Danica. She has posted the agenda. So I want to welcome everybody here this morning, and a special welcome for any first-timers. I saw on the list of attendees, we have quite a number of people attending for the first time, and definitely want to welcome you. We have about 175 people from 60 plus companies joining us right across Canada, so welcome everybody. And I want you to relax and enjoy the next 90 minutes of discussion. I just want to go through a few on the agenda here, a few housekeeping items, and then I'm going to welcome our CEO, Alistair Campbell, for a few words of welcome. But in terms of housekeeping items, everybody in this COVID era is now familiar with the Teams platform, and we ask if you're going to, we certainly invite your questions and comments throughout the broadcast, and just use the raise the hand at the top of your screen, and we will recognize you and ask you to turn on your camera and offer your question or comment. We certainly want to make this interactive and invite your participation all throughout the broadcast. Antitrust compliance applies throughout this broadcast. The Competition Act is in full bloom and applies to everybody here, so you remain competitors throughout the broadcast. And following later on, you're going to get a satisfaction survey, and I'll talk about that later on in the at the end of the broadcast. So I'm going to throw over now to our CEO, Alistair Campbell. We've been very busy here at PACICC the last little while, and Alistair is going to bring you up to speed on policy issues, and then I'll take it back from him, and we'll move on to our panel discussion. So over to you, Alistair.
Thanks, Ian, and happy Friday, everyone. And thanks so much for your engagement in our session today. Just quick PACICC updates, if that's okay. So first, just to make it clear that we've made progress on one of our largest initiatives in a while. And so we actually closed last Friday on a standby line of credit facility, which was intended to enhance the financial capacity of the organization to handle the distress or failure of an average-sized or bigger insurance company. We have 60 million roughly in the compensation fund, but our models indicated that that would just simply not be adequate for the scope and scale of the required liquidity in the very short term in the case of a larger failure. So we explored, as you probably know, a number of options around reinsurance or resuming capital levies of the industry. Our board concluded that if we could get the right deal for a standby line of credit, that would be the most cost-effective and sensible for the industry. So we have successfully placed a $250 million facility, which is subscribed to by all 6 of the major Canadian financial institutions, the banks. Took a while to get them all to play nicely together in the sandbox, but that has taken effect as of last Friday. There is an increase in the administrative assessment for all of PACICC members to cover the cost of this. But the majority of that increase will be carried by the larger firms for whom this additional liquidity would be required. And so a big step forward for us on one of our key planks of modernization. Just in terms of quick updates on our key priorities for 2023, we, as you will probably recall, did a review of our coverage and benefits for the first time in ages. 3 years ago, we promised the regulators that we would do it every 5 years going forward, but given how long it had been since the last time it had been done, they would like the next one to be done in 3. We agreed, our board agreed to that, and so that process has been initiated. It started with a comprehensive data call to the industry, and we are now in the process of crunching through claims data from 75 or 80% of PACICC members. It'll be a comprehensive data analysis of average cost of claim, personal property, auto, commercial property, and liability. The regulators asked us a very specific request this time, which was to add a provincial indicator. So for the first time, we will actually get a sense of what PACICC coverage looks like and the adequacy of our benefits relative to average cost to claim province by province. I think the old rule of thumb in law was that you don't ask a question you don't already know the answer to. In this case, we've asked a question we genuinely don't know the answer to because the regulators required us to do so. We will know at a high level if there is some fundamental difference in the quality of PACICC's consumer protections between PEI and British Columbia in the course of March, April. And we will be discussing our findings with the board in April and then coming back to the industry in the course of the summer to get some feedback from you. Our other major initiative is to initiate an application process for a bridge insurer with OSFI. A best practice in resolution is to have a facility prepared in advance to handle various scenarios where a bridge entity makes sense. To best practice subscribed to by the Financial Stability Board and the International Association of Insurance Supervisors. CDIC on the banking side in Canada has a bridge bank ready and waiting. Assurus, our life insurance peer to PACICC in Canada, has CompCorp Life and OSFI supervised insurer in a drawer ready for emergency scenarios. PACICC doesn't. And as we've been modeling through scenarios with our board over the last couple of years, it's become clear that it would be better if we had this tool in our toolkit. We initiated the discussions with OSFI. They've given us a shortened application form, which isn't quite the same thing as OSFI saying yes, but it's certainly an indication that the supervisory regime probably agrees that this tool would be a handy thing to have as part of the resolution infrastructure of Canada. So that will also involve some significant option and decision discussion around governance model and capitalization. And we plan to come to the industry in the summer for a dialogue around that as well. Final topic is with regard to our permanent priority until such time as it's fixed, which is earthquake. We are on tenterhooks waiting for what will come out of the next federal budget. There is a team at finance that has been working hard on this file. But in the fall, it became increasingly clear that the appetite of the federal government, or at least the bureaucrats, was moving towards some form of multi-peril option, something that could maybe provide institutional capacity and capability to respond to a number of tail risk scenarios, starting with flood. So we've always argued at PACICC that the industry can handle flood. And while there are public policy issues associated with that kind of 9–10% of the population that struggles to find affordable coverage, that's a very different public policy problem from the tail risk associated with systemic contagion after the megaquake. That having been said, it's a higher degree of difficulty dive, but it's not impossible to create an institution that could kind of help with public-private partnership solutions to multiple perils, and it's been done in other countries, including the UK and France and Spain. And so we're curious to see where the file evolves in the course of the budget disclosure. We're optimistic that there will be continued progress, but we are concerned that there is a risk that the primary focus will end up being on flood for lots of good reasons. But that ends up further postponing what we still see at PACICC as being the most urgent public policy gap in the kind of financial services infrastructure of Canada, which is a way to deal with the systemic risk associated with the megaquake. So more on that to come once we get a clearer sense of where the federal government is evolving its thinking in partnership with us and the IBC. So a lot on the plate, but a huge amount of progress as well, and a highly motivating start to the year. Hope all of you have got through your IFRS 17 joys and are moving forward into what will clearly be a challenging inflationary environment in 23. but hope you all finished with a good close to 2022 and are as excited as we are about the prospects for the coming year. There are risks everywhere, and so I'm very excited to have the chance to listen in on this high-quality panel that Ian has curated for your participation and pleasure. Ian, back to you.
Thank you very much, Alistair. You're going to note in the top of your screen that the session is being recorded. You're going to see this on our website very shortly afterwards. This is always the most popular, it seems, of all the webinars we're going to do each year, the risk identification and risk assessment. We try to set the table for risk management for the year, give you an idea of things that you should be aware of, and you're going to hear straight from the industry. We reach out to a representative panel and want to hear from them firsthand in terms of what they do. And for others in the industry, it gives you a chance to essentially look over the fence and see what others are doing and perhaps areas of improvement in your organization. So very pleased to introduce our panel. Katie Lake is Assistant Vice President, Risk Management with CAA Club Group. Pete Blouin is Vice President, Actuary, and Chief Risk Officer with Berkley Canada. And he happens to have one of the most impressive beards, I think, in the industry. So welcome, Pete. And Rahul Gumber, Chief Risk Officer Canada for Aviva Canada Inc. Rahul is joining us from London, so you win the award for giving up your Friday evening to talk to us about risk management issues, so well done. We had a little pre-meeting on this and thought it would be good to start with, first of all, a definition, a working definition of emerging risks. We have looked at this topic for the last 5 years. This is our 5th year doing this to start the year. And the working definition we've always used is an emerging risk is an accelerating risk where the outcome or implications are not known or clearly assessed, and or where there's not appropriate ownership or classification of the risk. So for purposes of the questions you're going to hear today, that is the working definition of emerging risk. And so we've, amongst the panel here, agreed that maybe we'd perhaps throw to each of them to talk about introduce themselves and talk about the structure of risk management in their organization, their teams, the size, scope, and nature of the teams. And maybe I can throw it over to Katie first. You can introduce yourself and the nature, scope of the work risk management that you do in your organization. So are you, Katie?
Thanks, Ian. So good morning, everyone. I'm Katie Lake. I'm the AVP of Risk Management for CAA Club Group, which includes our insurance subsidiaries, Echelon Insurance, who's a specialty insurer, CAA Insurance, a P&C insurer, and Orion Travel Insurance. Our risk team, we have a total of 8 people, including our CRO, and our CRO reports into our COO, CEO, and to the Audit and Risk Committee of our board. We have 4 audit and risk committees, which we do quarterly reporting for, and my responsibilities include ERM, ORM, project risk management, board reporting, the senior management risk committees, capital management, including the ORSA process, and our risk financing programs of corporate insurance and reinsurance.
Great.
I'll hand it over to Rahul.
Okay. Rahul?
Thanks a lot, Ian and Katie. So good morning to you all, and good afternoon to anyone if they're in London. So I'm the Aviva Canada Chief Risk Officer. I've been in the business for about 10 months, but more like 10 years in Aviva, having previously worked in Ireland and the UK. As a lot of you will know, Aviva is a UK-based company, so we've got a UK parent, and I think that's driven much of our approach to risk management and the frameworks, which are really driven by UK expectations and requirements. Within my team, I have both risk and compliance. Madonna Branch, we are a collection of legal entities, so we do have a Aviva Canada board of directors. So my reporting lines, I've got 3 of them. One's a CEO, I need to keep them happy. I also report into London to the group CRO, and then I also report into the board risk committee and the chair of that. So I'll stop there and I'll move on to Pete.
Thanks, Rahul. So I'm Pete Blouin. I'm currently the Chief Risk Officer for Berkley Canada. We do operate as a branch in Canada. We're part of a much larger global organization. Berkley is a US company. We have over 50 operating companies. From a Canada perspective, I would be responsible for the ORSA and implementing group risk strategy. My team here is both actuarial and risk. It's very small, but as a company, we have a huge network. Over 50 operating companies means there's 50 plus chief risk officers that we have the opportunity to collaborate with, and there's a global ERM team at corporate that we all report into from risk perspectives, for the U.S.
Okay, great. So we've got a series of questions here, and I'll give you the categories, and we're just going to go through these in order. But I'm going to ask our speakers for information on the tools and the risk identification sources they use. We're going to look at specific risks. We're going to look at processes, strategies, and approaches, and then their observations about the industry, and also a couple of questions to close on the current operating environment with respect to reinsurance and the macroeconomic outlook. So first off, about tools and risk identification sources. What risk identification tools do you use, and how and from whom do you get risk information in your organization? So let's maybe start with Katie on this one.
Sure. So in terms of risk identification tools, we use both internal and external sources. So internally, we have our bottom-up RCSA process, which is at the department level for risk identification and assessment, and then our top-down executive risk committees for our top company-wide risks. We also have a project risk assessment process where our key strategic projects, we have embedded risk identification and assessment into that project execution process. And then we track KRIs, KPIs, their trending, which allows us to see what risks are trending upwards. Externally, we use things like emerging risk scans, which includes industry publications on that. Obviously, what's going on in the news, your headlines, any research papers, RIMS articles. We also have discussions with our third parties. So whether that's our reinsurance brokers or reinsurers, or same for corporate insurance brokers or insurers. And then just anything that's coming out of the regulatory updates. And then those external sources are really used to identify any new risks or ones that are emerging that we then take that information back and discuss with management about their applicability.
Okay, great. And Rahul, how about yourself? Tools and risk sources, please.
I think Katie's pretty well covered it very comprehensively. So as Kate said, look, both internal and external. We'll look at external publications, articles, white papers, trade press, what the regulators are saying, not only in Canada, but also abroad. And then internally, you'll look at your internal committees, your debates, discussions, operational data, SME input, RCSAs, etc. And that all goes into the mix as part of the risk identification process. In terms of tools, it's quite a manual process, really. But there are opportunities to use advanced analytical techniques to support the risk identification process, which I may just touch on a bit later.
Okay, thank you. And Pete, how about yourself?
We're pretty similar for the identification piece. So maybe I'll go a little bit into the structure that we use. So we have a it's a group-wide risk register. So basically, we maintain a master list of all insurance risks. Each individual risk gets assigned a risk owner. It gets evaluated on inherent risk. So we'll look at the severity, we'll look at frequency, we'll look at speed of onset, and then we'll document sources of mitigation, and then we'll identify things based on net risk, from a perspective of what's the impact on group capital. So that process being updated annually. That's a good source that we get for getting input from the individual risk owners, from underwriters on things that need to be changed, reevaluated, additional sources for monitoring. So that in general, that's a pretty good tool that we've been able to maintain.
And I want to reach out to everybody as we go through this broadcast. We'll throw the questions open to you as well. If you hear from our panelists and there are other points you can add to that, certainly we welcome your input. So keep that in mind as we go through this. Second question about, it's really forward looking, and it kind of built on the first question. What sources of information for scanning the horizon for future emerging risks do you use or would you recommend? Benchmark studies? Are there other sources? Maybe we'll throw over to Rahul for this.
Yeah, sure. There's loads, aren't there? And probably too many to mention. Some that I've used recently, and as I said, there's lots of others. I think the World Economic Forum's Global Risk Report is a really good resource, which covers all the major risks that the world could be facing in the coming years over the shorter and longer term horizons. The likes of Swiss Re and Lloyd's, I think, have good research pieces and thought leadership on emerging risks. So I'll definitely encourage you to look up those websites. The consultancies like PwC, they do their insurance banana skins, which comes out every couple of years. And I think there's one coming 2023, I think. I may be wrong. And then the other one that came to my mind was the CRO Forum, which as part of its emerging risks initiative produces a risk radar, which covers all the risks that may have a significant impact on the insurance sector over the next 1 to 10 years. So that's just some suggestions, but there'll be loads.
Okay. And Pete, how about yourself?
Yeah, similar, a lot of external sources. One I'd like to detail, we license it's a third-party software that it's basically an industry database that identifies emerging risks based on, the first step is, things that have scientific evidence of BI or environmental damage. Then it looks at, mining, legal outcomes. Is there going to be some liability risk associated with those? And finally, it looks at whether or not there's some clash potential. It also does, give some examples of scenarios related to that. That software has been pretty helpful for us. We're able to monitor, what we call litigion agents. So that, there's a lot of third-party software out there now, and a lot of that stuff is able to be created as there's new, AI and machine learning techniques. Like, something like this, you can scan a huge volume of academic papers to get kind of like an aggregated view on, which risks are actually taking hold. So I think we're probably going to see more of that as that technology advances.
Okay, and Katie.
Yeah, I think the other panelists mentioned a lot of the good sources. I think we also attend industry conferences, right, where you get a sense of sort of what other people in the industry are seeing in terms of emerging risks. Another thing we do is monitor some metrics. So like right now, recession and inflation are something that's top of mind. So we're monitoring indexes related to that. So whether that's your inflation rates, your gas prices, your GDP growth, things like that, that we're just monitoring. I think another thing that we also do is we own quite a few different companies. So we have like a roadside travel insurance, government relations section of our company. And so the other thing we do is sort of take what we're seeing happening at other areas of different companies that aren't necessarily our insurance business, and then apply that to our insurance businesses to see what's coming in from those sources as well.
Okay, great. And Pete, I'm going to look to you to start this next question. At your organization, how does strategic planning and risk management work together on the identification of emerging risk issues, and how effectively are these functions collaborating to support strategic decisions?
I mean, for us, it's, risk management is always acting as checks and balances, making sure that, anything in the strategic plan, mitigates other risks so we can focus on insurance risk. As we're doing, primarily casualty, and the focus is always make sure that, if we're taking on risk, it's primarily insurance risk. So, making sure that those risks are desirable, to help execute the strategy, application of the risk matrix, and making sure that we're staying within risk appetite. And, the actual application of the matrix, make sure that, certain things, if it's, above a certain threshold for how much capital is exposed, it requires like, senior management approval, or, all the way up to the board. So I'd say those functions integrate pretty well.
Okay, great. And Katie, how about yourself?
Yeah, at our organization, strategic planning is a multi-step process where we source ideas from both senior management and from the board. And those ideas are then discussed and teased out to determine what's feasible and in alignment with our risk appetite versus not. And then these ideas get funneled up into a formal executive strat planning process, which then gets taken to the board for approval on future strategies. So as part of that strategic planning document that's utilized to perform the process, a section of it is set aside for the risk team to talk about what our current risk appetite ranges are on both a consolidated basis and a more detailed level to help guide that discussion on what type of strategies would fit within that risk appetite. And then the risk team also conducts formal emerging risk reports that go to both senior management and the board twice a year. And so those reports inform the strategy setters of any emerging risks on the horizon, which are then considered when they're setting the strategic direction.
Okay, great. And Rahul?
Very so. I mean, I think strategic planning and risk management has to work hand in hand. And as you go through your strategy setting process and your business planning, risk management has to be a consideration throughout. And that's not just from the second line, but mainly really from the first line. And then the second line obviously has a role to play in terms of input, advice, challenge, oversight. You know, we do the usual stuff. And then when it comes to the execution of the strategy, those individual strategic decisions, you've got, again, first line identification of risk, second line oversight, challenge, etc. So there's like multi layers of it, and there needs to be really strong collaboration and great engagement. And it's very important not to do anything in silos, because I think it's through that debate and that challenge and constructive conflict that you'll get to better decision making.
Okay, we are doing our enterprise risk management survey in June. We'll be going to all members out there for our biannual survey. But one of the questions, and it kind of builds on that last one, and Rahul talked about engagement. This next question is something we're seeing growth in terms of the engagement at lower levels in the organization. Do you see value in surveying internal employees and or external partners as part of your emerging risk identification process? Why or why not? Maybe Rahul, can we ask you to pick up on that?
Sure. Yes, absolutely. I think we'd be pretty unwise not to welcome that diversity of thought and diversity of opinion when it comes to the identification of emerging risks. In terms of specific tools, I'm not sure I'm the wrong person to ask, really. I think we did in the past, we used SurveyMonkey or something like that, and I think there's much more sophisticated tools out there. I think rather than tool, I think what's important is how you structure the survey. So you want to make it really easy for people to participate. So multiple choice questions are sort of helpful, but we also know the richness often comes from the verbatim comments and contributions. So you have to strike the right balance. You don't want to make it too long, you take a look at a long survey and you don't bother filling it out. In terms of frequency, I think we risk survey fatigue if we're doing it too often, and we're always being asked to fill out some survey or other, aren't we? So I think probably annually, perhaps with some shorter, more focused surveys in between. So I think strike the right balance between multiple choice and free checks. Make it short, don't do it too frequently, and of course, make sure you're asking the right questions.
All good points, absolutely, and definitely the answers you get much will depend on the questions you ask. So let's throw over to Pete on that.
Yeah, there's absolutely value in it. You know, whether it's internal or external, I think that, you know, changes a little bit, you know, how often you can ask. You know, I think internally we have a lot of success. You know, we'll have like quarterly chief risk officer meetings. Emerging risks is always a topic. And, you know, just by asking, hey, what do you want to see covered? You know, we'll get a pretty good idea of, you know, what people's main concerns are, and that'll give us, you know, a chance to see what to focus on. When looking at external stuff, occasionally we'll do, you know, individual surveys, but, you know, it's usually like a web survey. You know, those have benefits. You know, they're harder to, you know, get a consistent level of response. So, you know, we find that, you know, we're most successful getting external feedback when we're doing like, you know, line of business or specialty specific presentations. Like if our environmental group is, you know, doing an industry presentation or a broker presentation, the same concept of, hey, what are you concerned about? What do you want to see? What are your clients asking about? You know, gathering feedback that way usually is the best way to get that information.
Okay, great. And I see, Alistair, you have your hand up. Let's throw over to you.
Thanks, Ian.
Yeah.
I was just listening to the commentary about risk appetite a second ago before we got into the engagement discussion. So my question is around there. The industry just went through a very challenging reinsurance renewal cycle. And so I'm assuming that risk leaders like yourselves would have been directly engaged in the process of determining what your reinsurance team should go to market and acquire in terms of coverage. But there must be a feedback loop after you didn't get what you asked for. And maybe you did, but as we understand it, many folks didn't. And in fact, kind of whole categories of coverage like aggregate covers to protect you against multiple kind of mini cats basically disappeared as a product from the Canadian market. And many of our members, as I understand it, were required to take higher nets than perhaps they'd planned, and maybe buy a little bit less at the top end because the high end wasn't available or was just too expensive. So I would be very interested in hearing from each of you how the feedback from the reinsurance buying process looped back into the risk team. And did that require you to recalculate what risk appetite limits you might have for certain lines of coverage or departments in your organizations?
Good question. Maybe Katie, can we throw to you to start this one?
Sure. Yeah, so it was a very hard market this year for reinsurance. The things our risk management team is quite involved in the reinsurance process in terms of consulting with the lines of business on what types of coverage that we need. So from a risk management perspective, we're embedded into that process. So we worked with management to determine where were there opportunities for us to rejig our coverages, where were there opportunities where we were willing to take on more risk that would still be within our risk appetites, and where were areas that we decided we wanted to push back on reinsurers. We also leveraged some of our long-term relationships with our reinsurers where we could, and continue to try to market to them why we were a good risk. And all of those things led us to be able to get our reinsurance renewal terms that we did. So feedback afterwards from the buying process, part of that does change some of our KRIs or KPIs that we would be tracking from a reinsurance perspective of what are our minimum level of limits of risk that we're willing to accept. And so there was discussion about whether we change some of those things, and any discussion about whether we need to consider when we're setting our internal target, whether we need to raise the amount of capital that we need to hold. So those discussions were had. It doesn't necessarily mean that there were a ton of changes as a result of that, but we are pretty embedded into the process, which is great.
Okay. And Rahul, what was your experience with the reinsurance, the hard market?
Yeah, it was an interesting December for anyone involved in the reinsurance placements, that's for sure. And yeah, look, what was great, there was very, very good risk engagement and involvement in the purchasing process. And there was some real strong partnering between ourselves and the finance teams. And like Katie, we were very, very much involved in throughout. In terms of the feedback loop and the outputs, absolutely. Look, it's all very well wanting something and having certain appetites, but the market was only going to accept what it accepts. And there was certainly a feedback loop back into appetites and tolerances. Like Katie, it doesn't necessarily mean that things will change, and there's other things that throw into the mix when you're looking at internal targets. So looking at what's happening with inflation, look what's happening with interest rates. Look, there's a number of other things that all throw into the mix when you're devising your internal target. But definitely one of the considerations would be if there had been any changes in the retention on the CAP program.
Okay, and Pete?
Yeah, it's the risk department and reinsurance department are pretty closely aligned. Similar comments to what's been said, but I would say, one of the things we notice is that, when, decisions at the, the larger group level are made, sometimes it makes, changes in appetite, more likely at the local or the branch level for individual operating companies. Like, we can't get a group treaty anymore. That could lead to reduced appetite locally. And I think we did see that in some areas for sure. It's nice to be kind of casualty focused. So, there's casualty market hasn't been as difficult as the property market. So we definitely see it at the local level for sure.
Good question, Alistair. Thank you for that. And certainly we welcome questions and comments from our viewers out there. So do raise your hand if you have a question or comment as we go through this. And I'll be talking later on about the program. We have the risk officers meeting coming up on March 30th, and we actually have a reinsurance update from Guy Carpenter and Aon Canada. So you're going to want to tune into that. But let's move on. We have some smaller organizations out there that are interested in perhaps developing their emerging risks capabilities. It's maybe not an area that is a primary concern for some. It depends. It's all hands on deck. You're only so big and you can only concentrate on so many things. But are there tips from the panel for implementing an emerging risk identification process in their organization? So if somebody out there is feeling vulnerable right now, maybe we just don't have the strength, the capability that you folks have. How do we go about strengthening this? What do we do? What are some building blocks to making us stronger, more resilient with respect to emerging risk identification? So maybe Rahul, to throw over to you on this.
Yep, sure. So I think specifically in relation to risk identification, my main tip is really to cast the net wide. I think you want to make the top of the funnel as wide as possible to capture in your identification process a very broad range of risks. So use lots of different inputs, both internally and externally, and Katie and Pete have spoken about what they use, and as have I. And if you can automate some of that, that's great. And Pete touched on this earlier. So what I mean by that is, if you think about all the various sources of information, you've got external publications, articles, white papers, internal sources. There's a lot of information you have to trawl through to come up with a sensible, manageable list of emerging risks. And if you can use advanced analytical techniques such as natural language processing, machine learning, other AI, whatever, to consume all that information and represent it in a sensible way, I think that will give you a real head start. And look, there may be tools out there that can really help you with that. I think then the trick is to then have a good, consistent and clear approach to assess the risks through a few different lenses. So you'll look at impact, you'll look at likelihood, you'll look at proximity, you'll look at velocity. But I think you just need to be super careful about that and think super carefully about it in the context of the outcomes you want to drive. So what exactly are you trying to measure? And more importantly, why? So I would recommend you spend a lot of time upfront thinking about that as you develop your methodology and approach, as it will save you time down the road, but you'll also need to be agile enough to adapt the process as necessary. So in a nutshell, think carefully about how you set it up, automate it as much as possible, and then be ready to pivot and adapt as necessary and refine the process to get it working really well.
Very helpful.
And take comfort in the fact that it's difficult even in the very, very big organizations.
It can be overwhelming just hearing about the sources of information and again, filtering it down to something that's practical for the size of your organization is very important. Pete, how about yourself on that question?
Yeah. So, I mean, all I would add to that is, regardless of how you're able to identify the risks, the next most important thing you can do is, keep continuing on that process with, once you've identified them, how are you measuring them and how do you operationalize it? So, talking about that casualty database that we use, like when I first saw it as a tool, I thought it was incredible. I thought it had tons of value, but, it's a challenge to get, how do I get the underwriters to think about this? How do you get them to give you that feedback and know that it's going somewhere? So, don't just stop at identification, keep going, get as much engagement as you can with any of the frontline people, whether it's claims or whether it's underwriting. Just, know that, once these are identified, you're going to monitor them and you're going to find a way to make it part of their underwriting process.
Okay, great. We're going to move on. I think we've exhausted risks in terms of tools and risk identification sources. We're going to now move to specific risks. And again, in our emerging risk, or sorry, our enterprise risk management survey, we ask members what are risks you're going to face in the next 3 years that you're concerned about. What are risks you're going to face in the next 3 to 10 years that you're concerned about. And cyber and government regulation come up always in those answers. So the next question is, cyber and regulation are significant risks already facing the industry. Although they're present and currently being dealt with, the quick evolving pace in each of these areas may qualify them as emerging. Do you share this perspective, and how are you addressing the uncertainty within each of these risks? So we've heard cyber's out there, and it seems to reinvent itself all the time as new hacks are being made. So they are. Do you still classify these as emerging risks, given that they've been dealt with, or they're being dealt with right now? What's your take on that? So I'm going to ask Pete, and I'm going to ask Rahul for answers on that question. So Pete, let's throw it over to you.
Yeah, definitely yes. I think for us the biggest one's probably still cyber as a specialty insurer. One of the main issues that we have with cyber is, there's a lot of stuff that's still not reported. The other issue that we have is we see, big uptick in interest only after specific events. So it's, how do we get companies to be thinking about it more prospectively, before there's an event? The way that we try to stay on top of this, it's a similar process to, how you would look at other emerging risks is, looking at different academic papers or studies. There's a lot of scenarios out there that you can look at. I think, think about, I think at one of the PACICC meetings, we had talked about like a blackout scenario. So, coming up with published scenarios, adapting them to your portfolio and seeing, what's the possible exposure. The other benefit to that information gathering is sometimes it gives you, additional information that you might need to collect on your portfolio. So looking at the events that happen, like how could we have, collected this information? How could we look at, monitoring our own aggregates? So, always looking for, ways that you could have identified this stuff earlier.
And Rahul, yourself with cyber and government regulation, they've been around. Do you share this perspective that they're emerging, or what do you think?
Yeah, for sure. I think if you think back to the definition that you gave at the top of the meeting, an accelerating risk where the outcome implications are not known or clearly assessed. I mean, think about both the risks. They are evolving, changing risks, and as a result, I would certainly class them as emerging risks. I think, with regulation and legislation, we have a better playbook for how we deal with those risks, because we have processes in place to identify regulatory change and legislative change, and to drive that change through the business, to assess its impact, to report it up. And look, that doesn't mean we can fully mitigate all the changes that are coming down the track, but we do have processes in place. With cyber, it's a bit more difficult, and it's a bit different because the nature of the risk is evolving so quickly. The threat is always changing. I think we'll have an opportunity to talk about it in a bit more depth later, but I do see them both as emerging risks, but I think, like Pete, the cyber one's the slightly trickier one from my perspective.
Okay, let's move on to, as an industry, what role do you think we play in ESG issues, environmental, social, and governmental issues? And let's perhaps throw to Katie on this one. What's our role in dealing with ESG?
Thanks. I think our role is one of balance between supporting the ESG goals while continuing to provide for needs of our insureds. Part of that role is disclosing our ESG plans and how we're working towards those goals, which we see the federal government is committed to with the TCFD framework, and OSFI released their draft B15 climate risk management guideline for consultation. So we're seeing that come out in many different ways. A big part of what we do at CCG is advocate for our members And I think that same mindset of advocacy can apply to our insurance companies as well, in terms of advocating for what type of regulatory changes we want to see within the industry in relation to ESG, advocating to make those informed decisions from the ground up, from where houses are built and what type of resistant materials are used, to better informing our consumers and insureds. For the social side of things, I think we're all responsible for that, as a leader, as an employee, as a decision maker for the company. And from a governance standpoint, I think that goes hand in hand with risk management as part of being that second line of defense and providing that independent challenge and professional judgment, and just making sure that you have that alignment from top down and bottom up within the organization to make sure that you're encouraging open lines of communication.
Okay, thank you. And Pete, over to you on ESG, the role our industry plays.
Yeah, so I'll take this one from the perspective of supporting the clients. Ultimately we need to provide some kind of solution that supports them. I think probably our biggest exposure on that might be on the D&O side. With all the additional disclosure requirements. One of the ways that we can do that, as a specialty insurer, is make sure that our clients are aware of best practices. And we've had some success bringing in external law firms to kind of give individual presentations, both to clients, to brokers, and try to develop some kind of best practices. And it's going to be continually evolving, but just making sure that any information we have, we're going to provide it to our customers, and to try to get to a place where best practices are in place.
Okay, and close this out, Rahul, on ESG.
Yeah, and you'll have to forgive the Aviva pitch on this one, but I am pretty proud of what we've been doing, Aviva, globally and both in Canada. So I think we very much think so that tackling the climate crisis and addressing systemic issues such as disparities in diversity and inclusion, and investing in our societies and our economies is it's not just the right thing to do. It's absolutely essential for our success. And we see, Canada's a big country. There's varied geography that's increasingly prone to volatile weather, so flooding, forest fires, droughts, severe winds, hailstorms, whatever. I think as leading P&C insurers, we do see the impact of climate change on our customers and on our communities firsthand. And we know the frequency and severity of weather events and the associated economic costs are increasing. And if that continues to increase for the decades ahead, the viability of certain types of insurance will be called into question. So I think, look, preventing the most extreme cat impacts of climate change is going to take real action. And we have at Aviva set clear targets around this, which I think are some of the most ambitious of any insurer in the world. And we want to lead the industry in transition to net zero by 2040. And the ways we'll do that, we're reducing our operational footprint. We're going to be investing with intent. We're going to broaden our appetite and help businesses transition, including through providing, for example, renewals coverage. And we are testing new ways to embed sustainable claims handling into our claims processes. We released our sustainability report last year, and that explains how we're contributing to creating a more modern, fair and agile society. And it's a good read. I'd recommend you look it up, Google it, you'll find it. And I think what will be clear there is Aviva's commitment definitely to high quality and transparent governance. It also talks about how we're supporting progress and equity across our societies and communities we work with, and how we're continuing to listen to and be informed of new issues and opportunities as they emerge.
Okay. So we dealt with the pandemic with COVID-19. We like to think we're over it and everybody's returning to work, and that's a good thing, but that presents risks for the industry. So Pete, I'll throw it to you on this one. What risks do you foresee as a result of large volumes of workers now returning to the offices after COVID-19? So first it was dealing with the pandemic, and that was a challenge unto its own. And now that we're beyond that, it's now right sizing and returning to work. And what does an office look like now? How many people are in that office and all of that? So let's throw it to you on this.
I mean, I'd say the two biggest ones, definitely operational risk and definitely EPL risk in general. I think, trying to make sure that return to office is appropriate. I mean, I'm certain there'll be some EPL claims coming up from, how that return to work mandate might be implemented. There's definitely going to be some challenge with some newer employees that, maybe didn't have a, traditional university experience. They may have been remotely and now they're dropped into an office environment. So there's definitely going to be some challenges from that. And one of the things that I think we're going to see is, onboarding and offboarding risk when we're looking at like a remote employee to a remote employee. Like there's definitely some things that could be dropped in that transition. So I think it's, largely going to be operational.
Okay, so we're just anecdotally, we're returning to the office and we're at a flexible work arrangement that's going to continue in the PACICC office for the foreseeable future. It seems to be the new normal. Amongst yourselves, what does your office look like now that we're beyond COVID, quote, quote? Is it things return to normal? Are you flexible work environment in terms of some people being at home? Katie, let's throw to you. What does your office look like now?
Sure. So we have a flexible work environment, a hybrid one where individuals are able to work from home or to come into the office. We have taken a look at our footprint in terms of property, in terms of what we think we need versus what we don't need. So that is something that we have discussed about. But I think right now there's still a lot of unknowns in terms of what the end state long-term looks like for where we're working. And we're trying to balance that flexibility of employees that employees want, but also balance that with how important it is to have some of those in-person relational aspects of business.
Yeah, the camaraderie is quite important. Rahul, how about yourself? But with your
Yes,
office,
same.
are you back fully staffed? Is it what a hybrid model? What are you folks doing?
Yeah, no, I was always fully staffed, but they were at home, and now they're more coming into the office. So we do have flexible working arrangements, and like everyone else, we're doing hybrid working, and we're seeing more and more people in the office, which is great. And there are reasons why people would have to come in. So we know it's good for collaboration. We know building those relationships is important, building trust is important, and there's water cooler conversation. So I think there's great reason why hybrid works well. Personally, I'm probably in the office, between 3 and 4 times a week, but that wouldn't be the expectation of the rest of my team. But we do like to see people coming back to the office for sure.
Mm-hmm. And Pete, how about yourself?
Yeah,
what does your
pretty
office
similar.
look like now?
It's hybrid. Most people are in kind of that Tuesday, Wednesday, Thursday range. There's almost nobody here today, but yeah, I think it's just a continuing challenge to figure out like who really does need to be in the office. And I think everybody should have some kind of, office time just to benefit from the environment and kind of building a culture. But again, it's a hard case to make that it should be mandatory every day. We're going to settle somewhere in between.
Yep. I see Sonia. Sonia Kundi has her hand up. So maybe Sonia, you could activate your camera and question or comment. Join in, please.
Can you see me now?
Yes, I can. Yep.
Okay. I fully echo what all the panelists have said. I think it's challenging for people that are new to industry and for people that are new to a company as well, right? To really get that knowledge sharing and just learning on the job that you would get when you're in the office. So I think as we know, we've got an aging population in the insurance industry. It can be challenging to attract young, fresh, new talent to the industry. And if we're not able to actually onboard them and share the knowledge of our older, more seasoned employees, shall we say, it's going to provide future challenges to us as well, right? So I think it's a really difficult one to balance right now.
And I think that makes great sense, and it really depends on the organization in terms of trying to get the proper fit. Another question came out in the chat. What have been your wins and struggles in managing culture and talent development through a remote environment? Let's go to Pete on this one. We'll go right through the panel. We'll start with Pete.
I mean, it really varies department to department. I think, probably one of the wins that I had was, trying to get my staff engaged. Like, we ended up, instead of having, like a traditional like staffing meeting, we'll do something like crosswords over a Zoom call where everybody can participate and you can, share the screen and write on it. And, just having like a regular touch point, naturally, work stuff will always come up, and it just, having that kind of regular touch points just made it, pretty successful, I think. I have no issues with my team, and I'm fully comfortable with them, working remotely going forward. So I think it's, finding a way to stay connected and, reducing the barrier to reaching out, because I think a lot of some of the issues are, it might be easy to go talk to someone in person when you're here, but it feels kind of like, you're almost like you're bothering them when they're at home. So it's like, just trying to find that balance. But yeah, regular touch points that are, maybe, could be fun, could just be, less technical. I think that helps.
Yeah, big on the fun factor. How about Rahul? Wins and struggles in managing culture and talent in your organization?
Good question. I think, well, I think one of the wins is that we've maintained, or actually maybe it's increased, engagement through the pandemic. So we have I'm talking about my team, we have a highly engaged team. So that I feel is a bit of a win to have maintained people's engagement through all the hybrid working and all the volatility of COVID. I think in talent development, there's been some wins as well. I mean, I'm thinking of my time in Ireland now, and my successor was onboarded as my head of compliance through COVID, and clearly something went well or something went right because she eventually became the chief risk officer there. So it was, entirely possible getting someone on board, onboarding them through COVID and virtually, and getting them, ready to become the chief risk officer. Notwithstanding what Sonia said, I think there may be an accelerator if we're doing it face to face. Struggle. I think the struggles really are. It's kind of at the start. It's kind of tricky to get people coming back into the office, and I think we all felt the same, right? Because it's nice being at home, and you don't have to bother about getting dressed, really. Well, you have to put something on, but you don't have to be too smart, and you don't have to worry about the commute, and you can just pop into the fridge if you're hungry. Like it's really nice being at home. And actually, after being so used to that for 2 years, it was a struggle even for me to get in. So I can imagine it was for the rest of my team. But I think it's quite quickly, once you're in, once you're having that camaraderie, once you're with your colleagues, once you're feeling that renewed energy, I think people actually start liking coming in. But it was just breaking the back of it. That was a bit of a struggle.
Like one effect is probably stretching the working day, that people are working, stretching their, it's not a problem now to send emails out at 7 p.m. and worry about people looking at their watch when they receive this. Katie, how about yourself, managing culture and talent in the COVID times?
Yeah, I think what everyone said so far is true. I think that in terms of engagement, what we try to do is make sure that within the team, we have multiple touch points with each other throughout. Like once a week, we have sort of a team meeting, but then once a month, we bring everyone into the office. We have a lunch together. We do one of our team meetings in person like that, and sort of try and continue to build that engagement within the team, which I think has worked out pretty good. And in terms of like us as risk management, we also have to work with a lot of different areas of the business. Like it's not just internally our own team. Like we also have to then build those relationships out with the different areas of the business. So for us, it's just continual touch points. Taking a couple minutes during the first couple minutes of every meeting to have a chat that's non-work related, to ask what's going on in other people's lives. And in terms of talent development, I think that's just part of our our role as a leader to make sure that part of what I'm doing with my time during the day is to build into my team and to make sure that I'm also offering them those development opportunities, whether that's further education or a designation or learning something new. Like, I'm making sure that I'm having that feedback loop of what do you need from me? What do I need from you? And how can I help support you in that?
And Sonia noted in the chat here, it's all about making the in-person experience meaningful, not just a sense of meeting for the sake of meeting. We had a staff meeting earlier this week, and we're all kind of living vicariously through our colleague. Grant Kelly had his car stolen over the weekend, so we got to hear all about claims management and how his insurer was managing the file, and quite successfully. It all went well. Okay, so let's move on to the next question under specific risks. What risks do you foresee from non-traditional disruptors in the industry, such as Google and Amazon? And we're going to approach Rahul and Pete on this one. So what risks, Rahul, do you foresee from non-traditional disruptors in the industry?
I think as an industry, it'd be remiss of us not to be mindful of the threats of the likes of the Metas, the Apples, the Microsofts, the Amazons, the Alphabets, whoever, the big tech firms. Undoubtedly, they have skills in digitization and data science and strong brand recognition to attract customers, and that's all a very powerful combination. And we know Google and its parent Alphabet and some of its subs have dipped their toe into insurance through various partnerships, including investments in insurtechs. I think they partnered with Swiss Re, and they also backed the first fully digital and algorithmically driven Lloyd's syndicate, if I were to say. Amazon's also had a number of insurance-related partnerships over the years, and I think in the UK they launched a price comparison website back in October. But like, for whatever reason, when it comes to selling directly to consumers, that hasn't happened yet. And remember, is that surprising? It's a highly regulated sector with high reputation and political risks. And what they don't have is our history or our data or our people, our muscle memory, our capabilities, our customer base, our leadership. We know how to run an insurance company, right? So I think, how do we respond? I think you could have an hour and a half on that itself. But clearly, we can't rest on our laurels. We've got to continue to innovate, continue to use the data and tools and capabilities available to us to offer great, innovative solutions to our customers. I think in the short term, we might see some of the big tech firms partnering with incumbents, and perhaps medium to longer term, they may choose to enter the financial services more directly by trying to capture more of the value chain. But I think there's an opportunity for insurers to get ahead of the threat, partner where it makes sense to do so, and continue to disrupt and innovate our own industry rather than being disrupted by someone else.
It can be a good thing, a challenge to the industry. And Pete, how about yourself on that, in terms of non-traditional disruptors, the risks?
I mean, I would say kind of, the traditional industry response to, the disruptors is, really focusing on that, the technical expertise and, the knowledge piece of it, like that part being irreplaceable. I think that the challenge from the larger companies like Google and Amazon is that, they use their scale so effectively that they reduce the fixed and acquisition costs to a level that they can effectively, they have a bigger margin to work with that expertise part of it, and they can kind of learn on the job and get massive volumes of data quicker. So I think that's the biggest threat, just that, they're able to get enough capital behind it and have enough of a margin around that understanding that they can get there. And I just think that's the biggest risk.
Okay. This next question I'm going to throw to Rahul, and it deals with car insurance. What risks do you foresee in continuing down the path that we've seen for the auto insurance product in Canada?
There's a few. So look, lack of choice, right? I think everyone buys pretty much the same product regardless of their life situation. So there's limited options, which, not necessarily a good thing. I think within the product, when it comes to medical and disability, I think there is a certain opaqueness around what one may be entitled to. I think that if there could be clarity around that, there'd be less likely to have disputes. Auto insurance is quite politicized, and I think there have been attempts to reform it, but they haven't really did what they set out to do in terms of fixing the problem, and we still have actors in the system and in the value chain that aren't regulated. So total drivers, healthcare providers, ambulance chasers. I think there's also varied provincial regulation and provincial priorities. So it's a complex, complicated, and crowded area. I think there's also differences, and so if you have a accident in BC, on Ontario, Manitoba, Nova Scotia, whatever, I don't think there's standardized healthcare, right? So you don't know what treatment you're getting. It's not standardized, and there's not standardized costs. So it varies very much across the country, which to me anyway, and I'm new, it just doesn't really make a huge amount of sense. So I think there's a role for regulators and politicians to kind of level the playing field there. I think also there's a lack of understanding generally of how every premium dollar is spent and how much goes on claims and how much goes on commissions, expenditures, what the margins are. And I think there's some misinformation out there, perhaps, around the profitability in auto. So I think we need to level the playing field on data on auto insurance. And the last thing I'd say is around, we are seeing, it is an increasingly litigious environment, and you see the adverts around certain companies pumping a narrative, and you can get more money from your insurer, and that pushes the costs up, and they have to go somewhere. So I think there's a few things that we need to look into.
Okay, great, thank you. Let's move over to the category processes, strategies, and approaches, and I'm going to call on Katie and Rahul for this one. We've seen in our ERM surveys that there's a great difference amongst companies out there in terms of interaction with their board of directors. So how do you collect feedback from your board in your organization? Katie?
Sure. So we have pre-calls with our chairs of our audit and risk committee before our quarterly meetings, where we sort of talk through our mailing materials on a high level, and we solicit opinions and feedback from those chairs. And then we also collect feedback through questions asked at our board and audit and risk committee meetings. We conduct board education sessions where we elicit their feedback on what they would like to be further educated on. For example, over the last couple years, we've done some education sessions that were deep dives on certain risks within the company that they wanted more information about, like cyber technology. And our board chairs also email us questions and articles on emerging risks throughout the year. So we make sure that we encourage that open line of communication and dialogue between us and the board.
Okay, and Rahul, how about yourself in terms of contact with your board and direction from the board?
Yeah, a lot in the context of emerging risks. I think we do want the board to be a part of the emerging risk process. And there's a few ways of doing that. I think it's definitely worthwhile, and Katie alluded to this, reviewing the emerging risks register and the radar and the impact assessments, etc., with the board on a regular basis. I think we should be doing it at least annually. And I think you want more frequent, lighter touch points. So the way I do it is I'll report on the top-down risk assessment in my CRO report, and there's always an opportunity for the board risk committee and the board to discuss the risks as they're evolving and changing. And the board loves it. They love those sort of conversations because they know it's the sort of stuff that they ought to be focusing on, the big strategic things, thinking further down, a longer time horizon. And sometimes when you're in the nitty-gritty of the detail and you're dealing with business issues, it can be difficult to create the space to do that. So they very much enjoy it. If you can align all that with your strategic setting process, all the better, because they're really thinking in a different way as they go into that strategy setting. And if you can supplement that with external people that can really help them think about things differently, I think that's super useful. And then I think Kate spoke about it as well, the occasional deep dive we'll do, and we'll present that to the risk committee. And it all goes down very well. There's a lot of work involved in everything I've just spoken about, but I think in terms of value for the work, it's pretty positive.
Okay. And this next question, this is an all play, so let's throw it to everybody. And we'll start with Pete on this one. How can companies quantify the impacts of emerging risks such as cyber, pandemic, terrorism, etc., given the escalating rate of change in cyber exposure, both risks and required or expected responses? What are the panel's thoughts about how to quantify those exposures?
Well, I think for some of the known risks that have been around for a while, like, catastrophe risks, there's a lot of well-accepted third-party industry models that you can buy. So for emerging risks, it's, how can we progress towards that? Some of the first things that you can leverage some of the existing regulatory exercises, like, maybe add a cyber scenario to your FCT. The next step beyond that, you can start to research external, there's a lot of white papers from industry sources. Sometimes, consulting firms might put, specific scenarios out there, or academic papers, and just, start to develop, specific scenario models, or, beyond that, look at, internal models, just developing them, as it matures. Eventually we get to the place where you can go purchase a third-party model, but, before then, it's pretty much just gather all the information you can, start testing it out. Just try to develop like a range more than anything, just to see.
Okay, and Katie, quantifying the impact of emerging risks?
Yeah, I think Pete said it really well. Like, it depends on the type of exposure. You can use a model built by an external party, or one built by your own internal actuaries, or develop your own model within the risk team. Sometimes we do that with Excel, depending on the type of risk. For cyber, there are some cyber impact calculators out there. Chubb has one. You can input information like the number of records you have and your GWP, and the calculator will estimate the cost of a breach. And that's a good starting point. But it's also important to then consider some scenario analysis with that, or modeling, where you identify an event that would happen and then some assumptions within that, and then you consider what risk financing tools you have, and from there you can sort of quantify the impact of what that scenario would be. So whether you take that and embed that into your FCT process or your ORSA process, or just some on the side scenario analysis against maybe your budget, that's what I would do.
And Rahul, do you want to add to that?
Yeah, look, we spoke about it before, right? The threat's constantly evolving and becoming more sophisticated, which makes cyber insurance and cyber insurance quantification pretty tricky. I think when we're thinking about quantification, yes, we want to understand the risk to us, but I think there's value in also helping organizations understand their exposure, because that will really help them. It'll give them a baseline to prioritize their strategic investments in their cybersecurity, and it also raises their awareness beyond their IT and tech function into risk and business and the boardroom, so they can start making really informed decisions around how they hedge the risk and whether they need to purchase insurance. So there's definitely value in helping clients quantify. From our perspective, I think Katie just touched on it. There are models out there and firms out there that use cyber data listening and modeling capabilities to support the financial quantification of cyber risk, which is one route to go down. And then I think Pete spoke about scenarios. So I think if you can develop clear and precise scenarios specific to the organization, there's a lot of work in that. But I think it's a very valid and very beneficial way of quantifying the risk. It requires a lot of work. It requires very working very closely with stakeholders across the organization, and leveraging lots of internal and external data, as well as subject matter expertise, and then tailoring all that to your organization's context. And then when you're trying to think about the actual impacts of that, it's a complicated process, but I think if you do it well, it'll really enrich your understanding of where you may be exposed as a business.
Okay, great. I'm going to throw this next one to Katie. There's dangers in identifying the root causes of a risk and symptoms of a risk, confusing the two possibly. So are there questions one can ask when faced with this conundrum, trying to break out the root causes of a risk versus symptoms of a risk?
Yeah, that's probably going to sound cheesy, but I just continue to ask questions to drill down to what the root cause is and where it lies. And you may have heard of the approach of the 5 whys, where you ask the question why 5 times to help those responsible identify where the root cause of a problem is. And sometimes when you're doing that, along the way, you find areas where there could be controls improved or controls that have broken down. And sometimes that still isn't the end root cause, so you still have to continue to dig deeper after that. I think that pushing the business to think beyond their first immediate blame is part of the job of yours as a second line of defense, and how we can help advise and challenge them. The questions that I use really depend on the situation. Generally, you want to have a discussion about process, people, technology, and communication to start off with. And if the problem is really widespread and needs a more fulsome business process mapping to really see what went wrong, sometimes we'll then engage internal audit to do a deep dive as part of their audit plan to help with that.
Okay, I think if anyone out there has kids, they are very familiar with the 5 whys, that being asked why 5 times in a row. I'm very familiar with that. Okay, this next question I'm going to throw to Rahul and then back to Katie. How does the responsibility for identification of emerging risks get split out between the business, the first line, and risk management, the second line? So let's go to Rahul and then back to Katie on this one.
Yeah, I think, I like to push as much as I can to the first line. I really think that's where risk management ought to be. And obviously we've got a role in this as a second line, but in terms of the identification of emerging risks, for me, that really should be sitting within the first line. If you get it working well, you'll have your emerging risk processes in all your business areas, which will then aggregate up into an overall entity view. Second line has a role to play, of course. We set the frameworks, we set the methodology, we set the approach in collaboration with the first line. We'll probably have a role in facilitating the coordination of all that. We'll have a role in supplementing that with our own expertise and input. We'll have a role of challenge and oversight. But I think it's, that's our role: challenge, oversight, frameworks, and then actual identification, management, mitigation sits within the first line, and reporting is probably a shared responsibility.
Okay, I'm going to bring Alistair in on this. Alistair, over to you.
Thanks, Ian. And conscious of time, I did want to ask a practical question that maybe Rahul can help with in particular. But OSFI has made it very clear that in the course of this year, they are going to be issuing some form of new guideline with regard to culture risk. So on a list of items that you kind of feel are harder to audit and harder to establish metrics for, this might be one, but it's clearly a key pillar in the kind of strategic formulation that OSFI's driving forward under Superintendent Rutledge. I'd be very interested in getting a sense from all three how you're starting to think about tracking, measuring, reporting on this. But a lot of the leadership on the idea of culture as a risk has actually been coming out of the UK. And so I was wondering whether Rahul could have some helpful coaching and guidance that might inform all of us a bit more about this new trend.
So I've been at the UK for 4 years as my excuse for not being able to be too helpful here. I think, look, culture risk management, I get it. It's super, super important. In my time in Ireland, I think 5 of the 9 major non-life, I may have the stats wrong, had major governance issues which involved regulatory intervention. The root cause on every occasion was a poor corporate culture. So if you get the culture right, I think that has a significant impact on good governance, good risk management, good leadership, etc. So absolutely, I think it's super important that we get it right. For me, the question around this is, what more should we be doing? What aren't we doing that isn't already covered within other regulation and other aspects of our risk management and governance framework? So that's still a question out there, Alistair, for me, that I think we need to think about and answer. And in terms of measuring culture, there's lots of ways of doing it. As you know, Aviva is a UK-based company, so internally we've done risk culture surveys. So we actually write out to lots of people within the organisation, and you'll have a bunch of questions, and it'll be around governance, or it'll be around incentivization, or it'll be around safe to speak up, or it'll be around a bunch of other stuff, the role of the second line, etc. And there you can get some very rich feedback in terms of how people feel about the risk culture within the organization, and you can take action.
Great question. I'm going to, in being conscious of time, we have a few minutes left. I'm going to jump to the observations category, and these questions are all plays, so I'm going to ask everybody. So let's go to Katie, then Rahul, then Pete on this next question. What more should insurers be doing to promote the role of risk management across all functions in the organization? Katie?
So I think continued education is key to promote ownership from each line of defense and to continue to reinforce the importance of everyone's part in risk management. Something else that we do is to promote the advisory or helping hand aspect of risk management. So whether that's just having one of the department heads call us up to get our opinion on something to chat, or providing a second set of eyes on an operational project, we encourage that. Our door is always open, and we offer services like scenario analysis for the different business leads to come in and for us to help walk them through something like that. And I think another area that you can do to promote risk management is quantify some of the cost of not conducting good risk management. And so as part of our operational risk incident reporting process, we do collect data about how much did this incident cost us. And so taking that type of information, aggregating it, and sort of showing management, like here's the end dollar value of not conducting a fulsome risk management assessment or putting in the right controls. And that shows the importance of it.
Okay, and let's go to Rahul. What more should insurers be doing to promote the role of risk management across all functions in the organization?
I think we do a pretty good job. I think there is, there is some something in there around good communication and good branding of what we do, and of what if I'm thinking about this from a second line perspective, what explaining what the role is, how we contribute, the value proposition, how we influence better business decisions and outcomes, practical examples of where we have influenced things for the better to drive better customer outcomes. There's lots of there'll be loads of good stories in all of our areas around where we have really, really made a difference. And I think we need to get them and really start shouting about them and promoting the role of risk. I don't think risk functions are probably the best, or it's not an inherent skill around marketing and branding, but I think we should.
And Pete, closing out that one, promoting
really similar answer. I think of it as like rebranding us from the brakes to be just another way we can help people understand the business better. That's it comes down to that is when you're not a revenue generating center, like you got to reframe it as, well, this is we're preventing losses, and just getting that message across. We're not just here to be the brakes.
Okay, I'll try to work in a question here from the chat. Do you mind sharing, if I won't put people on the spot here, and maybe it's one of our viewers out there has something top of mind that they can chime in on. Do you mind sharing a practical emerging risk scenario in your organization and how that was handled? Is there something that comes to mind? Top of mind? COVID was who was prepared for that? We're hopefully still out of it.
It was a risk that was on all of our radars, pandemic, and and actually there's lots of lessons learned from that, right? Did we really understand the risk? Did we do the scenarios? Were the scenarios accurate in terms of how things panned out? If not, why not? So there's lots of considerations there. But in terms of the actual question, I think generally as an industry, I think, and I wasn't in Canada at the time, so I may get this wrong, but I think it was handled well, not because everyone had a deep understanding of the risk, but I think they did have the playbooks to actually respond to a crisis when it comes to communications and governance and measuring your exposures, etc. So I think as an industry, it went pretty well. I'm not sure about Canadian context though.
Okay, so I won't put people on the spot with that, but I also know Sonia said in the chat, it'll be interesting to see how OSFI fulfills the oversight role with regards to culture risk management. Okay, so let's, there's one more question to close out, and I know we've got like 3 minutes left. So once emerging risks have been identified in your organization, Katie, I'm going to start with you. What do you do with them? What's your strategy for advancing them for further research, product opportunities, et cetera? So once you've identified an emerging risks, what next?
Sure. So once it's identified, we then take them back to the different business areas to assess the potential impact on the company. So depending on the feedback that we receive on how significant our exposure is or where the opportunity could be, the risk is then funneled to different places from there. So whether that's at the department level within our bottom-up RCSA process, or whether it's significant enough that it gets brought up in our quarterly executive risk committee meetings, or gets put into our ERM report that goes to the audit and risk committee on a quarterly basis. So it just depends on the type of risk, and it could also lead to modeling the impact from a financial perspective, or researching what others are doing within the industry in terms of mitigating that type of risk.
Okay, great. And Pete, let's throw to you. So you've identified the risk. What next?
I mean, the next steps are going to be, what data do I need to gather to be able to monitor it? We'll also start to look at, what legal theories are out there. Like, are we going to have liability on this? Is there an actual legal connection? Is it going to be insurable? Just kind of going through the steps I described from the third-party software. It's like, does that connection exist? So yeah, I think you have to cast a wider net at first on all those steps, and then as you start to see the connection, then you get more like the rest of your risks, and you have kind of like some specific KPIs, some specific aggregation you're monitoring. But it's it's just starting to narrow down that funnel.
Okay, Rahul, to close out.
Yeah, very quickly, narrow down the funnel. So it depends on the nature of the risk. I think you want to do an assessment in terms of the impact. So if the risk materialized, how would it impact the business? What's the likelihood? At what velocity would it materialize? How quickly would the impact be felt, etc.? That's not a straightforward test. That's complicated. It does require some deep thinking. And it's also not straightforward as saying a risk materialized and this is the impact. Clearly, severity will depend, will be different likelihood. So your 1 in 10 pandemic is very different to a 1 in 200, which is why it's very important to have a clear methodology and approach. Anyway, once you've done that, you'll have a radar, you'll have a heat map, you'll have something fancy illustration, which should hopefully make it clear where are the risks that you need to spend a bit more time understanding the risk in terms of impact potential and the risk out there, but also in terms of the threats and the opportunities that there could be presenting off the back of it.
Okay, I want to thank everybody. This is probably a good time to close discussion down. Thanks everyone for being part of this. I want to thank our panelists, Katie Lake, Assistant Vice President, Risk Management with CAA Club Group, Peter Blouin, Vice President, Actuary and Chief Risk Officer with Berkley Canada, and Rahul Gumber, Chief Risk Officer Canada with Aviva Canada Inc. I want to thank you for your thoughts and opinions on the various risk issues. Looking ahead, I'll ask Danica to please post up there. You're going to see the invite next week. We're coming to you with a Risk Officers Forum on March 30th, and this is going to be a very, very popular, judging by past years. Jackie Friedland is going to be on hand talking as our keynote, talking about current industry issues, and then we're going to move to operational challenges of dealing with inflation. Donna Ince from Definity, Martin Kazaza from Zurich Canada, and Michael Lewis is invited. I'm just confirming Michael at this point with Marsh Canada. And then our second panel is confirmed. Peter Askew from Guy Carpenter Canada and Matt Wolf from Aon Canada are going to be talking about developments with reinsurance. So you're going to see me over the weekend. You're going to receive a satisfaction survey. Everybody out there, we certainly value your thoughts, your opinions. The quality of future broadcast is always enhanced with your opinions, ideas for future speakers and subject matter. So thanks for joining us today. Thank you, panelists. And this concludes our meeting. We look forward to having you join us on March 30th. In the meantime, stay safe, and we will see you soon. Bye for now.